You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions@TheOptionsInsider.com.
Ladies and gentlemen, kindly take your seats and please welcome from Box Options Exchange, Chief Executive Officer Ed Boyle.
Thank you. Good morning, everyone. I see they haven't turned the lights down in here. It's a little rough after yesterday. I hope everyone's enjoying themselves. This has been a great conference so far. I'd like to welcome our regulatory panel. Joe Kamnik from OCC will be moderating, and he will be introducing the panel. So thank you, everyone. Enjoy.
Good morning. Welcome, everyone, to the Regulatory Roadmap 2015 panel. Thank you for joining us early this morning. We met beforehand, and the panelists agreed that nothing interrupts the flow of a good panel like spontaneous applause. So please hold that until the end. But nothing contributes to the flow of a good panel like questions. So if you have any questions, raise your hand. Someone with a microphone will come around, and I'll recognize you so you can contribute. We'll have a Q&A session at the end, so the only thing I ask is that the questions please be on topic. We've got 45 minutes here, and the SEC and FINRA were kind enough to provide us with a lot of material. So without further ado, let's get started. I'll introduce the panelists first. To my right is Andrew Stevens, General Counsel for IMC Financial Markets. To his right, Sapna Patel, Head of Market Structure and Liquidity Strategy at Morgan Stanley. To her right is Dave Shillman, Associate Director at the SEC in Trading and Markets. Dave is responsible for the oversight of U.S. equity options and fixed income markets. And to his right is Jamie Brigagliano, partner at Sidley in Austin in the Securities and Derivatives Enforcement and Regulatory Group. Our first topic for today is an SEC proposal, which would be amendments to Rule 15b-9(1) to narrow an exemption that currently permits certain broker-dealers to trade in off-exchange venues without registering with FINRA. David, I'll turn it to you. Could you please talk about the proposal and the costs associated with it?
Well, sure. I'd be happy to give you an overview of the 15b-9(1) proposal. And this really is it's really fairly straightforward and simple in what we're trying to do and the rationale for it. This is one of a few initiatives that we are currently undertaking that are designed to update the regulatory framework to address the evolution of the markets, the rise of algorithmic trading, the rise of electronic cross-market proprietary trading firms that were not taken into account when the Commission originally implemented some of its structural oversight rules. 15b-9(1) is a rule that helps implement a statutory provision. In the 34 Act, Congress basically said if you're a member of an exchange, with respect to the exchange activity, the exchange is well positioned to oversee you. But if you transact other than on that exchange, then you should be a member of an association, because an association is charged with being the overseer of the over-the-counter market. We were to use our exemptive authority to create some additional flexibility in that basic principle, and we did so in an attempt to accommodate activities ancillary to single exchange-based floor activity. And at the time we adopted the rule, which in the 60s and was amended in the 70s, the world, of course, is very different than it is today. It was a floor-based exchanges. There were pure floor businesses, and there were ancillary activities off of the exchange. There were some commission sharing arrangements for referred trades. There also was the need, for example, for regional exchange specialists to hedge its risk on the primary market. So there was a de minimis exception in our rule for $1,000 for referred transactions, and we wanted to accommodate hedging off of the exchange. But the way the rule was drafted, it effectively permitted any proprietary trades off the exchange to be exempted. That was an issue back then because there was no such thing as electronic markets and high-frequency trading firms that traded cross markets. But over time, what has happened is that a number of the largest high-frequency trading firms have used that exemption to avoid FINRA membership, even though they do a very high level of activity in the over-the-counter market. Up to 40-some% of activity in ATS is by non-FINRA member firms. So the purpose of the proposal was to bring back that our exemptive rule in line with the original intent of Congress and the Commission's intent in adopting the rule. So simply, the rule would narrow this blanket exception for proprietary trading and say that you are exempt from association membership if you conduct business solely on the exchange of which you're a member and you do off-exchange transactions that are solely to hedge your floor-based activity. And there's another exception for NMS routing. But that really, in a nutshell, is the proposal. It's fairly straightforward. We expect that I think there are 125 or so firms that are not FINRA members. We know there are some, 14 or 15 very active cross-market proprietary trading firms that are likely to be caught by that and appropriately, in our view, become FINRA members. What is less clear are the number of firms that will legitimately be able to rely on the new exemption. Our sense is quite a few of those are options. The options tend to have more floor activity than the equities markets. I think there were just looking at, I think of the 125, 75 or 76 engaged in options activity. We don't know that it's exclusively exchange floor, but we think this will probably be a big issue for the options markets, and we certainly encourage comment by the options markets and options floor participants on the precise scope of the exemption. We ask a lot of questions. Should it be broader? Should it be narrower? But we are looking to the options community to give us more input on the scope of the exemption. And the costs are, it's a proposing release, so they're estimated costs, and they're pretty, based on information in hand, so they're pretty soft, and we certainly ask for comment on that. The main cost, well, it'll depend on the reaction. If you join FINRA, then it's going to be the costs of joining FINRA, hooking up to OATS, paying the FINRA fees. I mean, I think there's a sense that some of the fees, the trading activity fee, the Section 3 fees, some of that may be passed on indirectly today, but they would now be applied directly. So that there would be costs of that. And then other alternatives are comply with the exemption. There are costs of that, much lower, of course. And then it may be that some firms change their business model, although it's unclear how big of an issue that would be.
So, Dave, I'd like to follow up on one point. You mentioned that 125 firms or so are currently exempt from FINRA registration. 75 of those are predominantly options traders.
I don't know this, but they list options as one of their activities.
So, of those 125, do you know how many rely on the 15b91 exemption?
I don't know. I would imagine most probably do. I think, and again, we this is a proposing release, so we really are looking for input. But my sense is there probably aren't that many firms that do nothing off of an exchange which they're a member. So I would imagine most of them do.
Okay.
Some of them could still use it. Some of them couldn't.
Jamie, let's talk about the proposed exemption that Dave mentioned for hedging transactions. How likely is it that options trading firms might try to rely on this exemption?
Well, I think it would be very important. I guess the question is whether the scope of the exemption is carefully drawn enough and large enough to encompass options market makers who may not be viewed technically as sort of floor-based because of the evolution of technology. And I don't know if there's an issue there and others. I don't know, Sapna, do you have some occasion to think about that?
Yeah, I mean, I don't think, just kind of broadly, when you look at this proposal, you can argue against the intended goal. And the intended goal is to take the outdated rule and update it to basically account for the technological advances, the behavior changes that we've seen, and to basically address the unintended behavior that we're seeing people engage in with respect to that $1,000 threshold that some certain firms, not all, are leveraging. But then in trying to address that gap or the unintended consequences of regulation, you certainly don't want to put in place a proposal or proposed rules that would not broadly cover the type of activities that are legitimate. And so from an options market making or an options trader perspective, the world's evolved to the point where a lot of those activities are not necessarily floor-based, and there's legitimate activity that occurs in an automated manner off of a traditional floor. And so from that perspective, I think that the exception or the exemption should be broad enough to basically capture that type of activity, because I don't think those are the firms that you're necessarily trying to target with FINRA registration.
And that would be a factual question that would be important for us to get answers to. If there are electronic options firms that really are focused on a single exchange, that would be good to know.
Or limited hedging activity with respect to their options trade off exchange.
Right. So if that business model exists, we'd like to know about it, because it may be that floor then is not the limiting factor.
Mm-hmm.
Andrew, if I could ask you, if the outcome of this proposal is to require firms that are not currently registered with FINRA to register, I'm aware that your firm registered with FINRA within the last year. If you could tell us a little bit about the application process and some of the costs associated with being a FINRA member.
Of course. So first of all, as a FINRA member, I think I can say bring it on. We welcome. We welcome more to the party. We went through the FINRA application process last year, specifically because we were becoming a DMM on the New York Stock Exchange. So that was, FINRA membership was a requirement for that. Our application process took approximately 6 months from the beginning of the application to final approval. In defense of FINRA, they were obviously also looking at our NYSE application. They were looking at our DMM procedures, so it was not necessarily a straightforward application. But there is a cost associated with it. I think from a dollars and cents concept, I think it was in the $30,000 to $50,000 range. And obviously a lot of time and effort in terms of written supervisory procedures and the like. I think, though, generally speaking, most of firms like us, proprietary trading firms, electronic market making firms, because of regulatory services agreements where SROs have outsourced a lot of their work to FINRA over the last few years, our touch points with FINRA had been increasing over the last 5 to 6 years. So to have one association be that primary regulator, it certainly does help to level the playing field. It hopefully will reduce duplication. It will hopefully decrease inconsistent regulatory approaches or interpretations. And frankly, I'm also hopeful that by expanding the number of firms that will be FINRA members, by now having a touch points with many more types of participants, the appreciation for best practices across a scope of firms will increase as well.
Thank you, Andrew. Sapna, Dave mentioned one of the options, of course, is to cease trading and off-exchange activity if you don't want to register with FINRA. Mm-hmm. And Andrew pointed out for us some of the costs associated with FINRA membership. Should there be a concern that the proposal might, in fact, cause firms that are engaging in off-exchange trading to cease doing so and then have a negative impact on the provision of liquidity in the OTC markets?
I think that's a very fair point, and that's a very legitimate concern. I mean, aside from this proposal, we've already seen a lot of options market makers exit the business, and that impacts the liquidity that's available to the investor. And so to the extent that they're captured in this proposal for what might be legitimate activity that they're engaging in that would traditionally have been considered floor-based, that's something to be very mindful of. If they have to go through the cost and the burden of FINRA registration for their hedging activity, maybe that's an incentive when you're weighing the cost and benefits to just exiting the business altogether.
Yeah, and certainly that's something that we look forward to comment on and we'll assess. But looked at another way, if the margins of these firms really are so tight that they cannot bear the cost of oversight by FINRA, which all the other OTC market participants, then maybe they shouldn't. We shouldn't effectively be subsidizing that activity.
Dave, one of the commissioners at the meeting that released the proposal discussed the fact that there are some alternative proposals embedded in questions that are asked throughout the proposal, which is a common thing to do. Could you shed some light on some of the alternative ideas that are embedded in the questions?
Well, for those of you who read commission proposing releases, there are a great number of questions asked on every element of a proposal and all sorts of alternatives. And the 15b-9-1 proposal is no exception. So there were certainly a wide range of questions on the exemption. Do we have the exemption scoped right? Should it be broader? Should additional activities be allowed that are ancillary to floor-based activities? Should it not be limited to the floor? Should the exemption be better controlled? Should there be checks to make sure that the hedging exemption isn't abused by requiring certifications or internal reviews of the firms? There are other very wide-ranging approaches. Like should we, instead of looking to association membership, contemplate exchanges doing this through a combination of 17D2 agreements and RSAs? So a huge range of questions are asked, as is typical with SEC proposing releases.
Thank you. Last question on this, and this is for Jamie. FINRA is the only national securities association. So one of the commissioners also remarked that this proposal might have the unintended consequence of further entrenching FINRA's role. Should that be a concern?
Well, there's been an evolution, and in part driven actually by SROs who might compete with FINRA in the regulation space, but outsourcing to FINRA has certainly become the preferred solution. And I think regulators see benefits in that because, of course, and FINRA will always tell you that they can see the whole markets. They have X percentage, 80, 90% of the trading activity, and given cross-market, cross-product activities, it's important for them to be able to survey the whole landscape. I think, you can think about it in an antitrust paradigm. As any time you have a concentration of power, basically a monopoly, then you need regulation because you're not going to have competition, and in a regulatory space, I'm not sure that works. So what you have to have are, people like Dave and his examiners overseeing FINRA, which the SEC does, and make sure that they're looking at the right things and make sure that they don't have conflicts of interest. The industry's conflicts are always being examined, but you're right. We have to look at FINRA's conflicts as well.
Can I add one thing to that?
Yeah, please.
If you actually look back at the history of this rule, back to 1960-something, 64, Congress had intended there to be an alternative to NASD registration at the time. And so if you look at Congress's thought process, they didn't envision one entity as the sole place that you had to register. And so keeping that in mind and the direction we've gone with FINRA, it is a legitimate concern.
And certainly, this is an issue that we, flagged the impact on competition for regulatory services. Mm-hmm. I think, Jamie's point, I'm not sure how much this proposal requiring an additional, 50, 75, whatever the ultimate number is, registering with FINRA is going to exacerbate that problem. But it is, it's an issue that we look at in, more broadly as we look at self-regulatory organization structure. But I will note one possibility we did, flag in the proposing release, but it is that it could be firms that are engaged in a particular type of business, cross-market proprietary trading, may be incented to, explore, creating their own. This proposal might further entrench, FINRA's dominance, but it also could create incentives for alternatives.
Thank you for those very interesting comments. And as Dave remarked earlier, the comment period is open on the proposal right now. It closes June 1. So please, if you have comments, make sure to get them in. We'll shift gears a little bit now and talk about a FINRA proposal. that would require registration as a securities trader for those that design, develop, or significantly modify algo trading strategies. Andrew, can you tell us about the proposed rule and any costs that are associated with it?
Sure. So again, this is another one that I find ourselves as a proprietary trading firm supporting. We're the idea, of course, as communicated by FINRA, is for those individuals who are primarily responsible for the design and development of algorithms, automated trading strategies, or significant changes thereto should be registered. And that in this day and age where electronic trading and automation has taken over to a large degree in many respects the actual manual part of trading, then those people responsible for the algorithmic strategy should be registered as well. We generally support that in its current form, which is just a proposal and the beginning of the discussion. It appears to be principles based. It also, it's hard to suggest that you stand in contrast to this idea of education in the industry. We as a firm for a handful of years now have been registering a number of our individuals responsible for algorithmic strategies and the development thereof in certain capacities. So for us, because of the way we construct our firm, we don't consider this to be a difference maker. We actually feel that it's probably catching up to a lot of standard practices of firms within our industry. I think in terms of costs, I think the concern becomes it has to be principle-based. It has to reflect the different structures that firms in the industry have. It has to reflect the different level of complexity of the development life cycle that vary from firm to firm. If this becomes a game, so to speak, of identifying the one or two people that aren't registered, and then I think you have it becomes a bit more prescriptive, and I think you have a slippery slope of returns. But otherwise, we support the principle.
I'd like to follow up on a point you made there at the end. I think, from a principle perspective, it makes sense. But where the rubber hits the road, there are certain words in the proposal that are subject to interpretation. Primarily responsible, for example. Yeah. One of the concerns, and I'll turn it over to Sapna for this one, is if you have larger firms that could carve out responsibilities for the development or design of algo proposals, such that it could be that folks are not required to register because they have a little piece, versus smaller firms that have fewer personnel, and have to have broader insight into the development and design of the trading strategies. Is that a concern?
Not sure it's a legitimate concern. To Andrew's point, even within my own firm, I'd say a large number of the people you would think should be captured, whether they're on the business side or the IT side, are probably already registered. I think when FINRA was contemplating this early on, one of the concerns was, is every single IT developer who touches an algo going to have to be registered, which is a bit onerous. And so the fair balance is the primary responsibility language that's in there already. But I think regardless if you're focused on one or two individuals, large firm or small firm aside, you have others there that are already registered, and so I don't think it's as much of an impact from that perspective overall. Again, supportive of the proposal. I don't think you can argue against people having the necessary regulatory knowledge base when they're developing or modifying algos. It's something that occurs at this point already between the business unit and the IT folks. It's not like you're going to have the business person having a conversation with a customer saying, create this algo for me, and you hand it off to the IT developers without any additional input. And so from that perspective, I think this proposal goes in the right direction.
Okay.
Yeah, Joe, I just would note that a significant number of code developers also trade at some of these firms, so they're already doing it. Also, if outsourcing doesn't get you off the hook because you need the person at your firm who is overseeing the outsourced algo, that person may need to register as well. Where the FINRA developments may bite a little harder is that FINRA wants to see some separation of function between developers and testers and sometimes people who use the algos. They want to make sure that there isn't just one person doing the whole thing without other independent sort of parts of the firm overseeing it, and that's part of its companion release.
Dave, I hope that maybe you could shed some light on how this proposal would interact with the proposal we talked about first.
Well, I guess the interrelationship would be to the extent 15b9.1 requires more firms to become FINRA members, more people would be subject to the FINRA's associate person registration and supervision regime.
Okay, right, good point.
Would it be fair to and assume is always a very difficult word to use, would it be fair to think that if 15b9.1 doesn't come about or is slower to come about, for example, than the rule we're talking about now, that there would be some regulatory follow-on by a lot of the SROs to require the same sort of...
Yeah, and that's another dynamic here. It certainly could be the case that the exchanges themselves decided to implement similar rules.
I think we see that a lot in a lot of these registration concepts, so it wouldn't be too much of a shock to me.
Right.
This FINRA proposal is open for comment until May 18. If FINRA goes forward with the proposal, it must be filed with the SEC as a 19b1 rule filing where it will be open for comment again.
Yeah, and Joe, I note on that, as of at least, I think a week ago, I believe SIFMA was not planning to file a comment letter, and that may suggest, it may have changed, I don't know, Sapna, you may know, but it may indicate a relative acceptance of this proposal.
Silence is acceptance.
I think broadly, it's hard to argue against it.
Right, yeah, so that's to Sapna's point, but just...
Well, it's hard to argue against it, and it sounds as if the industry is already moving in that direction, if not already there.
Yeah.
And I think my anticipation would be that FIA PTG will file a comment letter. My expectation, now I'm getting a little bit out in front of it, my expectation would be it'll be somewhat consistent with the views that I've just shared, and just focusing on, maybe a couple of the concerns to make sure it's implemented in a way that's reasonable and allows a certain amount of flexibility for firms to design or to identify the people that again, match their structure or match the complexity of their development life cycle, much like a firm has the ability to design its written supervisory procedures.
Yeah, I mean, the rub could be down the road when certain exam teams come in and say, why isn't Mary registered?
That's right.
The firm will say, well, she's not our primary person, and that's where you're going to have the tension.
Yeah, I think that's always the tension point when you've got a broad principles-based requirement and the rubber hits the road when you're doing the exams, and I guess we'll see how it plays out.
Right.
Shifting gears again, Dave, we hope that you could provide us with some idea of market structure initiatives that might be on the Commission's radar over the next 6 months or so.
Sure. So as far as market structure initiatives, they really were, the ones we are actively pursuing are the ones that Chair White laid out last June in her market structure speech. That speech was focused on equity market structure, but some of the proposals will impact the options markets as well. And I think certainly have gone through and outlined that speech, and there are some actions to be taken by the FINRA and the exchanges, and they have been doing that with respect to enhanced transparency around SIP latencies, enhanced transparency about order routing. But as far as the Commission initiatives, I think there are 6, one of which, actually 3 of which really are designed to plug regulatory gaps, bring the regulatory regime in line with current state of the markets. One of those is 15b9.1, FINRA membership, which we just talked about. The other is making sure that active traders are registered as dealers, and that would involve clarifying some of the historic guidance around what it means to be in the business of buying and selling securities, which is the statutory definition. And again, this is a situation where the guidance that was produced really was last, revisited in the 90s, 80s, 90s, before the rise of active proprietary trading firms. And some of the parameters used back then to determine characteristics of a dealer were holding oneself out, having a regular clientele, things that really aren't squarely in line with the business of some of the active HFT firms. So I think the thought is do updated rule or guidance that would set forth more objective criteria that would clarify when someone is in the business of buying and selling securities, looking at activity levels, order routing trades, looking to see whether we don't want to capture long institutional investing, but looking to see whether the positions are relatively flat at the end of the day. So that is an initiative that's currently in development. The other regulatory gap initiative really goes to algos. And of course, orders today are rarely entered manually. They're done through algorithmic trading strategies. FINRA is doing addressing some of the issues we just discussed with associated person registration risk controls. I think on our end, we want to make sure there are appropriate records kept with respect to algorithms and the orders they generate. So first of all, making it clear that proprietary orders need to be kept as records, that if they're generated by an algo, that algo is identified with the order, and keeping records around with descriptions of the code, tools that are used to analyze the code, perhaps some versions of the code itself. So enhanced record keeping around algorithms is another piece. And the ones I've just mentioned I think will impact options markets equally. The other initiatives are more equity markets focused, and they go to operational transparency of order routing. So dark pool ATSs, a lot of concerns, particularly among institutions, that they don't know how they operate, how they treat different customers differently, and the like. Today, the forms ATS are confidential. They don't require a lot of detail in the information even the commission gets. So the thought is to require much more detailed information about their operations, require that be publicly disseminated. The other transparency type initiative is order routing transparency. We have 606, which is retail focused, but institutions, particularly with today's complex markets, are concerned about understanding better how their orders are routed, to what venues, the execution quality at those venues, and potential conflicts of interest that may arise through maker-taker fees, payment for order flow, or potential for information leakage. So another initiative would be to set forth standardized baseline disclosure about order routing that institutions could get from their brokers. Many institutions are getting that today already and more, but this would set a baseline for all institutions.
I'm sorry.
And then I'll just mention the last initiative is really gets to a substantive initiative, actually impacting trading behavior, and that's the so-called anti-disruptive trading rule, which if you look at, and we have been taking a data-driven, methodical approach to looking at high-frequency trading and its impact on the markets. We've been analyzing data. We've been summarizing the literature out there. The data seems to show that with high-frequency trade, there are many potential positives. Liquidity provision, increasing efficiency through arbitrage, but there could be some detrimental activities, the momentum trading strategies that exacerbate volatility and could undermine institutional execution quality. So I think the thought is identify some type of aggressive trading strategy in vulnerable market conditions that would be checked, perhaps in a way similar to the reg show test, in that if the market moves down or up a certain amount, then active traders would be precluded from trading aggressively, from hitting bids, for example.
Yeah, Joe, I wanted to jump in for a second on the just back to the FINRA algo, not the proposal to register, but the control and supervision and governance of algos, because that's live now. Mm-hmm. And in fact, FINRA's recent notice basically said, what firms have to have policies and procedures to monitor development, testing, making sure the algos are anti-manipulative, basically monitor every single function of the algos and the algos they provide to customers. And that reg notice reads like exam inquiries that we have seen with clients before the notice was issued, so it's nice that they codified it and published it. But I did want to mention that at FINRA, that's live, and if you have significant algos, you really need to be able to demonstrate that you have policies and procedures to govern every aspect of the trading. It's very comprehensive.
Can I respond to that? As a firm who's actually subjected to that? When we saw the FINRA notice and the supervision of algo provisions, a lot of it, when we looked at it, were things that we already do. And it was good to kind of see how FINRA thought about it in terms of reevaluating our current processes. So when you think about creating a new algo, based on customer demand or something that you want to offer to the marketplace, you typically have the conversation, the primary person responsible for the ask, as well as the algo developer, along with others within the firm, whether it's risk, it's legal, it's compliance. A lot of people have input into something that you're offering that broadly. So client customization aside. When you're rolling out that algo after it's been developed, you typically test it in a QA process. You want to make sure that the algo is doing what it should be doing, that you're capturing everything from upstream systems downstream for purposes of books and records, for ODEs, for trade reporting purposes. Then you move slowly after you get sign-off on that to a prod environment. And you're not just turning on all the flow. You're basically testing to make sure with live symbols or test symbols that the algo is doing what it should be doing. And then even when and this is kind of specific to my firm because I can't speak to other firms, even when we think the algo is going to function the way it should, we'll turn on principal flow first before we turn on customer flow so that the customer is not impacted by anything that we didn't catch the first time around. And then you gradually turn on the customer flow, and you're not doing a big bang. And so seeing a notice like that where you're seeing what FINRA's thought process is in terms of the processes that you should have in place, you're double-checking it versus what you already have and making sure that there aren't other areas that you need to improve.
Agreed. I actually think FINRA should be applauded for giving guidance. As a market participant, we're constantly trying to read the tea leaves, right, of enforcement actions or rule filings or what have you, not all of them being as clear as we would like from time to time. And so to get guidance on this topic from FINRA, I think is very, very helpful. I also think that they did a fairly comprehensive job at reviewing, citing, and assessing the best practice papers that have been out there for the last 2 or 3 years and collecting them for purposes of their guidance. I know as a member of FIA-PTG, we've put out a number of white papers, 2 or 3 over the last couple of years, about the development and implementation of risk controls, the development of software, how best practices related to that. And I know that at least a couple of those were referenced. And again, as a proprietary electronic trading firm, it's been in our best interest from day one to have a kind of a best practice approach to this. So to see a collection of those ideas as guidance from a regulator is always great to be able to double check it against what you do.
Yeah, I think the panelists would agree. It would behoove everyone to take a look at that guidance. Jamie made the point. It reads like sort of an examination protocol. Mm-hmm. We've got about 3.5 minutes left, and I do want to open it up for Q&A. So if anyone has any questions. Yes, sir. Do we have a mic?
Hi, I'm Joe Solito. I work at Susquehanna Investment Group.
Hi, Joe.
Hi. We're in favor or think it would be productive to have a symbol or a number of symbols open earlier prior to the opening, a few minutes, 5 minutes. Most of the major errors and problems that we've experienced over the last few years have been either software rollouts or inputs that have perpetuated, erroneous orders or quotes in the market. Would you support an initiative like that, and what do you think of it?
Anyone on the panel want to take that one?
Mm-hmm. I mean, from our perspective, we'd be happy to, if you have a developed idea, we'd be happy to have a discussion around that.
I think what's important is having test symbols that are provided by the exchanges, which was something that a lot of us were requesting over the years, not only to test your own functionality, but to test other people's functionality that they're rolling out to reduce that type of market impact.
Thank you. Question in the front.
Sorry, he found me first. Joy Rosenstein for Fidessa. Just on that note about the test symbols, it's actually a problem that we have in the options industry. There are no test symbols that are widely listed by Oprah. So as much as you have ZVZZT or the such in equities, there's no test options. Some exchanges have symbols, but they're not across all exchanges. So you couldn't even test an algo across all exchanges in the options world. So a lot of people, when they test things, are not able to do it effectively in options.
That's interesting.
Thank you for that comment.
Hello? Thank you. As an independent consultant who writes algorithms, I'm more concerned about this registration thing because it seems that what FINRA wants is to have an associated person who is, it's like asking Honda Motor Company or Toyota Motor Company to get a driver's license instead of the driver. A lot of algos are turned on autopilot, but there are also a lot of algos that have user control, and the user can manipulate how that algo goes. The requirement is that the primary person somehow register, but typically the primary person is not the person that's using the algo. So isn't this going in the wrong direction, requiring the wrong person to be an associated person? And while Ms. Patel is right about how Morgan Stanley turns on their algos, there are a number of firms that just turn on their algos without any testing whatsoever, and that's where the danger lies, not with whoever wrote the algo.
We've got about a minute left. If someone wants to take that.
Well, I think part of the effort is, and some of the clarity that I expect to see come out as the discussion continues, is the outsourced or third-party vendor concept for algo development. I think it's pretty clear that firms who do use third-party vendors or consultants to help with their algo development, they can't outsource their supervisory responsibilities. So I expect to see some clarity as to how that will play for those sort of firms.
Thank you. And please join me in thanking the panelists.
That was really quick.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.